We're joined this morning by Sandip Sabharwal, a market guest of AskSandipSabharwal.com. Sandip, apologies for mangling your name, happens sometimes with me. But can you take us through what you think about Ola Electric? And you put out a tweet which I thought was quite interesting. A lot of people are calling this a turnaround story. Do you agree?
I think Ola Electric, since it's got listed, it's been trying to turn around every quarter. So the management comes out with some sort of guidance, then the next quarter sales numbers come and they are totally different from what they have projected. And then the stock again corrects. So this time also the results were very disappointing, but they have again come out with a positive guidance, and that's exciting some people. Now the key is that can they change the consumer perception which has got built up that it's a subpar product in the market? And I think that will determine how well they'll do. What most people are also, most analysts I think are not also factoring in is that the rare earth magnets issue impacts the EVs the most. And Ola obviously is 100% EV. So how does that impact Ola Electric in the short run? That's another point to be considered. There's some excitement around the new e-bike, and that has received some positive reviews, and I think that's got some people excited. So we need to see how that gets accepted into the markets. I would think it will be premature to be very excited. It always happens then when the stock corrects so much that there is some bottom fishing which happens. I think that's playing out right now.
Sandip, good morning. Neeraj here, and good to have you on NDTV Profit. So thank you for taking the time out. Sandip, are you constructive, by and large constructive, select pockets currently on the markets, even if you may not be constructive markets overall, or are you bullish currently?
Yeah, Neeraj, good to see you after so many years. So I would think that on a macro basis, we need to be constructive on the markets because of various factors. And the macro factors, in my view, historically, my experience is that that is what determines where the market goes. Then you go back to individual stories. So on a macro basis, we have low inflation, low interest rates, a fiscal deficit in control, a current account balance which is well in control, and government spending which is picking up this year. So I think all these factors combined with a normal monsoon makes me positive on the economic growth prospects. So I think since if we are positive on economic growth prospects, it's difficult to be negative on the markets per se. Now, there are pockets of overvaluation, there are pockets of value, and there are segments which will not do well. So I think many of the export-oriented sectors is something we need to watch out for how they play out depending on how the trade deal goes. But IT is something which seems to be in deep stress. And I think that's one sector which can be avoided at this stage. At some point of time, these companies will become value buys because these are cash generating businesses which give out huge dividends and also do buybacks. So at some point of time, they will again become buys, but buys where we can maybe make 12-15%, but not hold them for the long term. But I think it's better to focus more on the domestic oriented sectors at this point of time.
Okay, Sandip, great to have you on. Tamanna here. We'll come back to you in a minute. I just want to get the big brokerage call of the day, and Harsh is standing by with that. This is something we do right before markets open, and Kalyan Jewellers is in focus with a target price, hold your breath, of 700 rupees by JM Financial. Why is that, Harsh?
Well, yes, it's a near 20% upside which JM Financial is building in. It's an initiating coverage report, and therefore good interest. In terms of the jewellery market itself, it's quite large is what JM is saying. It's worth around 6.5 lakh crore in the current market context, but the organized market is just a shade below 40% of that, and therefore the runway for growth is extremely large. They expect to witness higher growth of roughly 20% for the organized market from FY24 to FY28. That's largely going to be led by better quality, improved price pricing transparency and consolidation in the industry. All those three will play in favor of a Kalyan. Increased gold prices actually aided the unorganized market over the last 2 to 3 years. So now, with gold prices likely stabilizing as per JM, this should aid the organized market better than unorganized. In terms of moats, Kalyan has quite a few. They have trust, transparency, as well as effective marketing. They also have a hyper-local approach in terms of the way they market their jewelry. In each geography is very different, and the type of jewelry that they sell is also different. So the product mix is evolving. Further, they're adding stores aggressively. Expectations from JM, revenue CAGR of 25% all the way through FY28, 23% EBITDA CAGR, and a 31% PAT CAGR. Lower capex requirement in terms of adding stock count. There's a larger tailwind than a Tanishq has, because Tanishq is more penetrated. So Kalyan has that larger opportunity as well.
Okay, thank you for that, Harsh. Kalyan Jewellers there in focus. All right, Sandeep, let's come to your view on what you've seen with the tech pack and the IT pack so far. We've seen TCS numbers was a disappointment. We've seen HCL Tech numbers largely a disappointment. But do you think that there is a silver lining there where you see an improvement possibly in Q2?
Highly unlikely, Tamanna, because the macro factors don't seem to be improving at this stage. So my guess is that we will continue to see some stress going on. So these companies like the TCV order books, etc., have been okay for many of these companies. But the main issue is the project take-ups, executions, deferral of discretionary projects, etc. And there is a bigger risk, I would say, also standing in the mid-cap IT pack, because many investors seem to be sanguine about the prospects of mid-cap IT, where they say many investors are thinking that they will not be impacted, only the larger companies will be impacted. Historically, it's been seen that when discretionary spending gets deferred, the smaller companies also tend to be disproportionately affected. I think the mid-cap IT on a pure valuation basis right now carries more risk.
Okay, so mid-cap IT carries more risk. I'm just wondering whether, so Sandeep, one perspective, because the earnings season started off on a bit of a rocky note, is that perhaps we'll get done with the bad news first and the good news will trickle in after. Are you as sanguine or confident or hopeful that earnings will pick up over the course of the season?
So this quarter results, in my view, and my expectation also were muted for this quarter, because a lot of the factors which will lead to a revival in demand for many of the domestic-oriented companies plays out after this quarter. Like the monetary policy action started 6-7 months back. It takes typically 6 months for the monetary policy to start affecting on the ground. So I think that impact will be seen. The impact of normal monsoons will be seen in the festival season, etc. So my guess is first quarter results might still be muted overall. But from the second quarter, as the festival season also starts early this year, we will see a significant revival in demand in many product categories like consumer durables, non-durables, possibly auto if the rare earth magnet issue doesn't impact production. And we will also see a revival in construction, etc. activities, because last year was a subdued year. Then many companies won a lot of orders where the execution cycle will pick up from next quarter. So I think that's how people should be expecting the result season to play out.